All right, let's jump right into this masterclass investigation. Today, we are putting Gentherm Incorporated on trial, and we're going to do it by applying the legendary valuation frameworks of some absolute investing titans. We're acting as your expert investment analysts, taking all the raw data, the earnings, the market trends, and running them through the most rigorous filters in finance. If you've ever wondered exactly how Warren Buffett, Peter Lynch, or Benjamin Graham would evaluate a modern mid-cap stock, well, you are definitely in the right place. Here's our analytical roadmap for the explainer today. Number 1. Company snapshot. 2. The Buffett and Lynch lenses. 3. The Graham lens. 4. A DCF valuation. 5. Other valuation models. And finally, number 6. Our synthesis and final verdict.
Section 1. Company snapshot. The baseline facts. So Gentherm is a global market leader in innovative thermal management. Right now, it's trading near the top of its 52-week range at $41.47, sitting at a $1.1 billion market cap. And what's really fascinating about their core business is that they're the OEM, the original equipment manufacturer, behind the climate control seats in your car, the thermal management systems in EV batteries, and even advanced medical temperature systems. Really, they're a classic picks and shovels play on both electrification and comfort. The company is bringing some serious momentum to the table right now. They just posted record annual revenues of $1.5 billion. They've raised their 2026 sales guidance, and they're prepping for a massive transformational merger with Modine this year. Plus, they just launched a new $400 million stock buyback program. Now, as an analyst, when I see a company with a $1.1 billion market cap buying back $400 million of its own stock, that is a huge capital allocation signal. It means management literally thinks their shares are cheap. But, are they actually cheap? Let's find out.
Section 2. Buffett and Lynch lenses. The qualitative gurus.
Let's put on our first pair of glasses. Warren Buffett would absolutely love Gentherm's economic moat in this growing thermal management market. It's built on switching costs. Once a thermal system is integrated into an automaker's platform, it is incredibly hard to just rip it out. Plus, that upcoming Modine merger, it only widens the moat. On the other hand, Peter Lynch would categorize this as a cyclical stalwart. It's not some hyper-growth startup. It's a solid company riding a secular tailwind, specifically an industry that's compounding at an 8.24% annual rate. Looking closely at Buffett's checklist, Gentherm passes with flying colors on debt. They've slashed net leverage down to practically nothing, just 0.2x. And they show incredibly shareholder-friendly management with that massive buyback we talked about. They also generate consistent earnings, pulling in $18.2 million in 2025 net income. If we look at owner earnings, which is Buffett's favorite metric, by the way, they had $116.8 million in operating cash flow. Even after you strip out capital expenditures, you're left with a baseline of roughly $100 million in true free cash flow. The only real blemish here is a mixed return on equity, mostly due to recent margin compression from higher costs. But overall, a very Buffett-friendly business model. But here is where Peter Lynch is definitely raising an eyebrow. Assuming that industry average growth rate of 8.24%, Gentherm's sky-high PE ratio of 49.02 gives us a PEG ratio of roughly 5.95. That is well above Lynch's ideal target of 1. Remember, a PEG ratio divides the price to earnings by the growth rate to tell us if we're overpaying for that growth. At nearly 6, Lynch would absolutely argue you are paying a massive premium. The growth is there, for sure, but the price tag is exorbitant. So, the main takeaway from our qualitative gurus is this. While the business itself is highly defensible and really quite excellent, the current stock price demands absolute perfection. Buffett might love the business, but he'd demand a much wider margin of safety before even thinking about buying. And Lynch, he'd likely just sit on the sidelines until that PEG ratio cooled down a bit.
Section 3. The Graham lens. The quantitative wall.
Let's move over to Benjamin Graham's strict quantitative wall and run through his defensive investor checklist. Gentherm passes on size and earning stability, but fails pretty hard on the rest. They have a zero dividend history, an elevated PE multiple of 49, and a price-to-book of 1.54. Graham wants a PE under 15 and a price-to-book under 1.5, so they fail the multiple tests. And for a traditional defensive value investor, a total lack of a dividend is just an automatic deal-breaker.
And this brilliantly illustrates just how strict Graham's intrinsic value formula really is. Let's unpack the math for a second. Graham believed a fair PE is 15 and a fair price to book is 1.5. Multiplying those gives you 22.5. By taking the square root of 22.5 times the 0.74 EPS times the 26.93 book value per share, you get a hard mathematical anchor for intrinsic value. And that target? Just $21.17.
For Graham, at a current price of $41.47, there is absolutely zero margin of safety here. He literally wouldn't touch this stock until it saw a massive 50% correction. At today's valuation, you're driving a 20,000-pound truck over a 10,000-pound bridge. There's just no room for error. If that Modine merger hits a snag, or if auto manufacturing slows down, the stock has a really long way to fall to hit its Graham-defined floor.
Section 4. DCF Valuation, the lab work.
All right, let's transition from guru theory into the financial modeling lab. Because exact future cash flows aren't handed to us, we'll transparently assume a normalized baseline of $100 million in free cash flow, tracking that industry 8% growth rate. We got that $100 million base by looking at their $116.8 million operating cash flow and making a standard deduction for CapEx. We're going to grow that at 8% for 5 years, calculate a terminal value, and discount it all back to today.
We'll also plug in some standard industry assumptions to fill out the model: a 10% weighted average cost of capital, or WACC, and a conservative 2% terminal growth rate. That 10% discount rate represents the required return for the risk we're taking, and the 2% terminal rate assumes that, eventually, Gentherm will just grow in line with global GDP.
So, what does the DCF spit out? Under our base 10% WACC and 2% terminal growth, we get a fair value of roughly $35.40 per share. Notice, that's below today's trading price. If you're demanding a 12% return to hold the stock, fair value drops even further to $27.90. Really, the only way you can mathematically justify today's $41.47 price is if you use a highly optimistic 8% WACC. Strictly from a discounted cash flow perspective, the stock is currently trading at a premium.
Section 5. Other valuation models. Peer comparisons. Now let's look at some alternative peer comparisons. We see a pretty fascinating split here. A PE of 49 is sky high for an auto parts manufacturer, right? Yet a price-to-sales ratio of 0.72 actually suggests the stock is kind of cheap relative to its massive $1.5 billion in revenue. This is a crucial insight. It tells us Gentherm is generating incredible top-line sales, but they are suffering from squeezed profit margins. If they can streamline operations, maybe through this Modine integration, and bring those margins up to industry norms, earnings will explode, and that PE ratio will rapidly drop back to reality.
Furthermore, a reverse DCF tells us the market is already pricing in aggressive double-digit cash flow growth. A reverse DCF is an awesome tool, by the way. Instead of guessing inputs, we take today's price and calculate what growth the market actually expects. At $41.47, the market expects Gentherm to grow way faster than the industry average of 8.24%. They are pricing in flawless execution. Oh, and as for a dividend discount model, entirely useless here since the payout is exactly zero.
Section 6. Synthesis and Final Verdict. Time to bring it all together.
This is the grand synthesis of everything we've looked at today. Graham wouldn't buy unless it dropped near $21. Lynch would demand the price come down to reflect the 8% growth rate. The DCF suggests fair value is around the mid-30s. Honestly, only a speculator betting purely on margin expansion and sales multiples sees a clear buy at this level.
Blending all these insights impartially, our final expert verdict at the current price of $41.47 is a hold. Look, the fundamentals are undeniably strong. That 0.2x leverage means bankruptcy risk is practically non-existent, and the $400 million buyback puts a really nice floor under the stock. But as value analysts, we just don't pay for perfection before it happens. We need a margin of safety, and right now, the market has already priced in all the good news. So, I'll leave you with this final thought. Is the market perfectly pricing in the future synergies of the Modine merger, or are investors just driving a 10,000-pound truck over a bridge built for value? You'll want to keep a very close eye on those profit margins in the coming quarters, because if management can convert those $1.5 billion in sales into higher bottom-line earnings, this current valuation might suddenly look like an absolute steal. Until then, it's a fascinating study in how different frameworks view the exact same data. Thanks for joining me on this explainer, and I'll catch you on the next one.